Good morning, everyone, and a very warm welcome to today's webinar. We are pleased to have you all with us. My name is Sanya, and I will be your moderator for today's session. Before we begin, please feel free to share your questions in the chat throughout the webinar. We will address as many of them as possible during the session, and responses to any remaining questions will be shared with you via email after the session. We are delighted to have two seasoned transfer pricing professionals with us today, Priyanka Sondi and Himanshu Gautam, who will guide us through the webinar. I will now hand over the presentation to our speakers, who will begin by briefly introducing themselves. Priyanka, over to you.
Thank you, Sanya. Good morning, everyone, and thank you for taking the time to join us today. I am Priyanka Sondhi, a chartered accountant by profession, and I'm a transfer pricing specialist at Hexa. And it's a pleasure to have you all with us for this session. So, before we begin today's presentation, I would like to briefly set the context by taking you through the UAE tax landscape. So over the last 2 years, if we have to say, one of the biggest change in the UAE tax landscape has been the introduction of corporate tax. And with that, transfer pricing has moved from being a niche technical topic to a mainstream business compliance requirement now. In fact, if someone has asked 2 to 3 years ago, does transfer pricing really matters in the UAE? Many businesses would probably have answered not really. But today, however, the answer is completely changed. Transfer pricing is no longer something that only large multinational group needs to think about. Today, business of all size with related party and connected person transaction needs to understand their TP obligation. And also, with the federal tax authorities becoming increasingly active in this area, it's important not only to comply with the rules, but also to have a robust TP documentation to support your transfer pricing positions. And that's exactly why today's discussion is so important. Over the next 50 minutes, me and Himanshu will walk you through the UAE transfer pricing framework, understanding the key compliance requirement, discussing some of the most important significant development introduced over the past year. More importantly, we look at these development, what they means in practice, and the area businesses should be reviewing now to stay compliant and to reduce their transfer pricing risk. So generally, when we speak with clients, one of the common question that comes up again and again, that they know transfer pricing applies on them, but they're often unsure about what they need to do, what document they require, what FTA is gonna ask at the time of TP audit. These are some of the practical questions we'll try to answer today. So by end of this session, our objective is that you should have a clear understanding of not only the legal framework, but also the practical step that you can take to strengthen your TP position before your next corporate tax cycle. So with that, let's get started. So we have divided the today's session in two parts. In the first part, we'll be covering the fundamentals of the UAE transfer pricing framework. What are the rules, how the arm's length principle work, who are considered as related party, connected person, and what are the compliance requirement would be. And the second part, we'll be looking at the latest developments like advanced pricing agreement, which are already all relevant for the UAE. What are the downward TP adjustment, pillar 2 implications, the evolving audit landscape, and some of the important penalty related updates that has been introduced in UAE. So as we go through the session, please feel free to post your queries. At the end of the session, we'd like to answer them one by one. So with that overview, let's begin by looking at the overall UAE transfer pricing framework. Next slide. So with these slides, before we get into the recent development, it is important to understand where the transfer pricing rules actually comes from. This will help us know which document to refer to whenever we have any practical question coming up or on way related to transfer pricing. So as far as UAE transfer pricing framework is concerned, it is built on 5 key pillars. The first is a federal decree law, which introduced the UAE corporate tax regime. This is the primary legislation. It only established the arm's length principle and give the Federal Tax Authority, the FTA, the power to request the transfer pricing documentation from the taxpayer. The second is the cabinet resolution, which basically deal with the country by country report, specifically for the large multinational group. The third is the ministerial decision, which set out the threshold for preparing the master file and local file, along with the related document that company needs to maintain, the businesses needs to maintain and to support their policies. The fourth is FTA transfer pricing guide. This was published in 2023. Although it's not a really binding, it provides practical guidance on how FTA expects taxpayer to apply TP rules in practice. So all in all, in practice, it is a very important reference document. Finally, where the UAE legislation or FTA guidance does not provide a specific answer, we always have the OECD transfer pricing guidelines, which are generally used as a reference, since UAE framework is largely based on OECD principles. So with this background, now the key message from this slide is very, very simple. The arm's length principle applies to every related party and connected person transactions, whether it is domestic or it is a cross-border. So in practical terms, this means the rules can apply to businesses with domestic and cross-border related party transaction, free zone entities dealing with mainland companies or other group entities, small or medium-sized businesses with related party arrangements, qualified free zone persons, and owned managed business as well, where they are making payment to the connected person, such as director or shareholders. So in nutshell, the rules remains the same for everyone. The only difference is the level of compliance. So depending upon the threshold, you may have to make the required disclosures. Like if you are crossing the threshold, you might need to make the master file, the local file. If you're not crossing the threshold, you just need to make sure that the transactions are at arm's length, and then you can go ahead with your TP transactions. So we'll discuss these threshold in the next slide. We'll be discussing. Next slide. So one of the most important concept in transfer pricing, as the name suggests, if you can see the slide, the arm's length principle. At its core, the concept is actually quite simple. It means that the transaction between the related party should be priced in the same way as they would have been if the parties were completely independent of each other. In other simplified word, we can say just because two companies belong to the same group, that doesn't mean that you can charge whatever price you want. The pricing should reflect the independent businesses would have agreed to a similar circumstances. So once we know this concept, now the next question automatically comes to our mind: how do we determine that arm's length price? So this is where the transfer pricing methods comes into the picture. UAE corporate tax law recognized 5 internationally accepted methods, all of which are based on the OECD transfer pricing guidelines. The first is comparable uncontrolled price, or a CUP method, which compares the price charged in a related party transaction with the price charged in a similar transaction but between the independent parties. The second is resale price method, which is commonly used for distribution businesses, and look at the margin earned by the reseller when they are doing the distribution of goods and services. The third is cost plus method. As the name suggests, it starts with the supplier cost plus adds an appropriate arm's length markup on it. This method is often used for manufacturing and service transaction. The fourth will be transactional net margin method, or the TNMM. This is probably the method we see most often in practice. Instead of comparing the price, it compares the overall profit earned by the tested party with that of the comparable independent companies. Finally, the fifth method that we have is profit split method, which is generally used when two or more related party makes a unique and valuable contribution, and the profit needs to be allocated between them based on their contribution. So with this, now one question we often get: can we use different method apart from these 5? The answer in UAE transfer pricing regime is yes, but only in a limited situation. If none of these five methods can be relied upon, UAE law allow taxpayer to use another appropriate method, provided they can clearly demonstrate why the recognized method were not suitable and show that the alternate method they are using actually satisfy the arm's length principle, and maintain and definitely maintain the supporting documentations and information to support your sixth method, another appropriate method. So with this background, one practical point I would like to highlight is that the selected method should always be based on the facts of the transaction, the functions performed, the asset used, the risk assumed, and definitely the availability of reliable comparable data to support our conclusion. So before deciding the method, however, we first need to identify whether the transaction is actually with the related party or a connected person. So now let's look at that in the next slide. So most of the people assume that transfer pricing only applies between the companies within the same group. But under UAE corporate tax law, the scope is actually broader. The law covers two categories, the related party and the connected person. Let's go one by one. Let's first understand who is considered as a related party under the UAE corporate tax law. Article 35 of the corporate tax law contains a fairly broad definition. The related party relationship can arise through ownership, through control, family relationship, permanent establishment, partnership, even trust and foundations. Many people assume that the test is very simple. Whether one company owes 50% or more on another, it's done. While that's certainly one of the way a related party relationship can exist, but not the only one. The law also look at control. For example, a person has a control over the business through voting right, has the ability to appoint majority of board of directors, has the right to receive more than 50% of the profit. So if such kind of control exists, then also the companies, the businesses will become related party under this definition. In addition to control, law also recognize significant influence. So even where the ownership is below 50, a person may still be regarded as related party if based on the facts and circumstances it can be shown that they have the ability to influence the commercial or the financial decision of the business, they become related to each other. So the key takeaway in this is, don't look only at the shareholding pattern percentage. When assessing whether a related party relationship exists, you should consider the overall picture. You should consider the overall relationship, including the ownership, control, actual influence of the one person on the other entity, right? With this discussion on related party, now let's move to the second category, the connected person, which is covered under Article 36 of the corporate tax law. Unlike related party, this concept is specifically aimed at owned managed businesses. It includes directors, owners, officers of the business, and their related parties. The purpose of this provision is to ensure that the payment made to these individuals are commercially justified and reflect the market value. How? Let me give an example. So if a business pays a salary, bonus, management fee, director remuneration, rent, or any other benefits to the owner or director, those payments should be consistent with what an independent person would have received for providing the same services under similar circumstances. So for example, if the owner director pay themselves a salary that is significantly higher what someone performing the similar role would have earned in the market, or that person charges the company above market rent for a property that they personally own, the FTA will come into the picture and may disallow the excess amount as a deductible expense while arriving at taxable profitability. So the key takeaway here is connected person rule is not just about identifying the relationship. They focus on whether the payment to those individuals are at market value or not. And these expenses are incurred wholly and exclusively for the purpose of the business. They are not trying to shift the profit by making such payments to these owners and directors who are actually owning the business. Just to add here, with these definitions of a related party and connected person, on 29th April 2026, the FTA has also issued a public clarification where they have specifically gave a broader definition for director and officer. They have clarified the definition. For Article 36, director must be formally appointed by the board. Title alone is not enough. Officer need to actually strategically making decisions for the company. So with these clarification, we can understand that actually the authorities are very keen to know about all these information from the businesses. With this definition, let's move to the next slide. So now, as we have understood who the transfer pricing rule basically applies to, the next question automatically comes naturally to us: what exactly do we need to do? And this is where I have some good news. Not every business has to prepare every TP documentation. The level of compliance basically depends upon the size of the business and certain prescribed threshold. Let's start with the first requirement, that is a transfer pricing disclosure form. Think of this as FTA's ways of understanding your related party disclosure. The disclosure is filed together. It is a small document which is filed together with the corporate tax return, but it is not required for everyone. It applies only where the aggregate value of the related party transaction exceeds the 40 million AD during the year, during the tax period. And once the overall threshold cross, every transaction category exceeds the 4 million AD must be separately disclosed. Similarly, whenever there is a payment to the connected persons are reported where there exceeds the 500,000 AD during the year. So, right? So once we dealt with this disclosure, the next question is whether you also need to prepare the formal documentation, namely master file, local file. These are required only if either your multinational group consolidated revenue is at least 3.15 billion AD or your UAE entity's own revenue is 200 million AD or more during the tax period. So we have to keep in mind these threshold, and basis this threshold, if we are crossing these threshold, we need to make such compliance documentation. So now the next question comes is, what is master file? What is local file? Master file tells the FTA the story of multinational group, its business, its value chain, financial agreements, its intangible, and opposite to that, the local file, on the other hand, focuses only on the UAE entity, explains its related party transactions, justify whether the transactions are at arm's length or not. So with this background, one more, if you can see the screen, there is one more compliance that we need to do, which is basically required for the largest multinational group. There is one additional requirement, which is CBCR, country by country report. This follows the OECD framework, applies only to the group with the prescribed global revenue threshold, which is 3.15 billion AD of the consolidated group revenue. Now, with this background of this compliance requirement, there is one requirement I personally think is the most important, because it is the one businesses tend to underestimate, and that is maintaining the supporting documentation. This is not separate from that you are filing. It is all the evidence behind your TP positions, your intercompany agreement, your invoices, your benchmarking studies, your calculations, your board approvals, or any other document that can demonstrate how the pricing was determined. So, and this brings me to what I think is the most important message from this slide is, many businesses assume that if they don't cross the threshold, if they don't cross master file, local file threshold, transfer pricing is not really an issue for them. But that's not correct. Those thresholds only determine how much documentation you are required to prepare. They do not determine whether the arm's length principle is applied or not. If you have a transaction with related party and connected person, the pricing must still be at arm's length. In fact, Article 55 of the corporate tax law gives the FTA the power to request transfer pricing documentation from any taxpayer, irrespective of the fact whether they are required to maintain master file or local file. So once such request is issued, taxpayer generally has 30 days to provide that requested information. And That's why my practical advice is always the same. Don't prepare the TP documentation because FTA has asked for it. Prepare it because your transaction have already happened. It is always much easier and much more credible to have your analysis and supporting document ready before you file your tax return. So with this, we have almost covered the framework, the TP framework in UAE. Coming to the next slide, I would like to cover here common TP risk and practical mistakes that are happening. So these are some of the practical risk area that businesses should pay particular attention to. They are also the area they are commonly examined during the transfer pricing review and audit by the tax authorities, the FTA. Let's go through them one by one. Management fee and intra-group services. So many group charge management fee, IT fee, HR support services, finance support services, and other shared services cost across group entities. However, it is not enough to simply have an invoice. Businesses, businesses should be able to demonstrate that the services are actually provided, that they were needed by the recipient, and that they provided a genuine commercial benefit to the entity who is receiving these services. This whole concept is commonly referred as a benefit test. It is also important, I'm again and again repeating, it is also important to have a supporting document such as intercompany agreement, invoicing, allocation working, evidence that, that the service has been actually received. The second area where major focus is required is connected person transaction. As we discussed earlier, this includes payment made to owner, director, and another connected person. Whether it is a salary, bonus, rent, management fee, or in any form of remuneration, the amount should be commercially justified, broadly consistent with what an independent party would have received under the similar circumstances. So this is an area that owned businesses sometimes overlook because they don't associate it with the transfer pricing. They think that we are not required to. So they have to always keep their eyes open whenever there is such transaction between the connected person. The second is the related party financing. This is the area which is basically becoming increasingly focused by the authorities as well. Businesses should ensure that the interest rate for these financing reflects the arm's length rate, and it is supported by an appropriate transfer pricing analysis. It is equally important to document the commercial rationale for such financing arrangement and maintain relevant loan agreements and documents whosoever can support the commercial rationale for the same along with the arm's length nature. The fourth will be contemporaneous documentation. One of the most common mistake businesses make is waiting until they receive the information request, the formal information request from the FTA before preparing their TP documentation. But the actual scenario is the transfer pricing documentation is expected to be prepared on contemporaneous basis. That is at the time the transaction has been taken place or even before the tax return is filed, not retrospectively after the audit has already been started. So preparing documentation early should make it much more easier to respond if the FTA requests for such information. So this is also an area where a complete focus should be given by the businesses. The next is downward TP adjustment. Where the taxpayer wants to reduce its taxable income through the TP adjustment, the prescribed legal conditions needs to be satisfied. Business should also ensure that they have an adequate supporting documentation and wherever applicable evidences that the corresponding treatment has been recognized by the counterparty. We will discuss this topic in more detail when we'll cover the recent development by the FTA in the coming slides. The sixth point, the risk area which I would like to cover is domestic and free zone transaction. A common misconception, as I'm repeating myself again, a common misconception is that transfer pricing applies only to a cross-border transaction. That is not the case. Arm's length principle applies to domestic transaction, related party transaction as well. Maybe even if it is between the mainland and a free zone entities. So business should not assume simply because the transaction is taking place within UAE, TP doesn't apply. So here I would like to conclude this slide with that most transfer pricing adjustment does not arise because businesses deliberately get the pricing wrong. They arise because the business cannot adequately demonstrate and support their transfer pricing position. So major action should be done in this direction. So now we have almost completed the TP landscape of UAE. Coming to the next slide. Next slide. So this slide basically explains what has happened in UAE in those years. This why you can see from this slide why transfer pricing has become and such a hot topic in UAE over the last couple of years. If you look at these timelines, you will notice that framework has not developed overnight. Instead, we have seen a series of development that has gradually strengthened the UAE transfer pricing regime. 2023 rules introduced, 2024 international alignment by accepting the domestic minimum top-up tax, which is OECD Pillar 2, 2025, great certainty through APA, FTA introduced the first advanced pricing agreement guidance, 2026, not one, like more than four recent developments were introduced, more guidance, more strong enforcement. So transfer pricing rule themselves has not changed drastically since corporate tax was introduced. What really has changed is the level of clarity, guidance, and most importantly, enforcement by the authorities. So with this, I would like to invite Himanshu to take you through all the recent development that has been done in the last 1 year that we should keep in mind while dealing with our transfer pricing transactions. Yes, Himanshu, over to you.
Thank you, Priyanka. Good morning, everyone. I'm Himanshu Gautam, a transfer pricing consultant at HexaTP. Thank you for joining today's session, and we would look forward to discussing today's topic with you. Let's look at the first major development. One of the biggest changes over the past year is that UAE has introduced its first Advanced Pricing Agreement or APA program. This is an important step because until now, businesses didn't had a formal mechanism to obtain certainty over their transfer pricing positions in advance. So, question arises, what exactly is an APA? In simple terms, it's an agreement between taxpayer and the Federal Tax Authority or FTA, where both parties agree in advance on how a particular related party transaction will be priced for a future period. Instead of waiting for an audit several years later and debating whether pricing was at arm's length, both parties agree the transfer pricing approach upfront. This gives businesses much greater certainty and significantly reduces the risk of future disputes. At present, however, the program has a fairly limited scope. The UAE currently allows only unilateral APAs, which means the agreement is between taxpayer and the FTA only. In addition, the program currently applies only to domestic controlled transaction. The FTA has indicated that the cross-border APAs are expected to be introduced in future, but a commencement date has not yet been announced. So there are certain eligibility conditions in APAs, which are the control transaction proposed to be covered by the APAs can have a value of at least AED 100 million during the tax period. There can be some exceptions though. For tax groups, this threshold is assessed at the group level rather than for each individual entity. Once approved, an APA applies for 3 to 5 tax periods, giving businesses certainty over their transfer pricing treatment during that period. The UAE has also introduced an application fee. So what does this mean in practice? for many businesses, an APA won't be necessary because of its high eligibility threshold. However, if your business has large and recurring domestic related party transactions such as management services, shared service agreements, or significant intercompany financing, an APA could be worth considering. Rather than defending the same pricing position every year during an audit, an APA allows you to agree the transfer pricing methodology with the FTA upfront and provides certainty for several years. Of course, it's important to remember that the applying for an APA is entirely voluntary. It's not a compliance requirement, but a mechanism which is available to taxpayers who want greater certainty over complex and high-value transactions. Next slide, please. Let's now move to another important development that was issued very recently. In July 2026, the FTA issued public clarification CTP 11, which providing much needed guidance on downward transfer pricing adjustments. This clarification is significant because it changes how taxpayers make these adjustments in practice. Before this clarification, there was uncertainty around whether a taxpayer needed to obtain the FTA's approval before making a downward transfer pricing adjustment that reduced the taxable income. The FTA has now clarified that this is not required. Since the UAE corporate tax system operates on a self-assessment basis, the taxpayer can make downward transfer pricing adjustment directly in their corporate tax return, provided they meet the prescribed conditions. However, this does not mean the taxpayer have complete flexibility. The FTA has made it very clear that any downward adjustment must be properly supported. There are 4 key conditions that taxpayers should keep in mind. First, the adjustment should be fully disclosed in the tax return. Second, there should be clear commercial and transfer pricing rationale explaining why the adjustment is necessary. Third, the revised pricing should be supported by an appropriate transfer pricing analysis, including the updated benchmarking where relevant. And finally, there should be an evidence that the other party has made a corresponding adjustment so that the same income is not taxed twice or omitted together. So what does this mean in practice? The good news is that the businesses no longer have to wait for the FTA's approval before making a downward adjustment, making this process much more efficient. However, the responsibility has shifted to taxpayer now. If you make downward adjustment, you should assume that the FTA may review it during an audit. Therefore, filing the income tax return, make sure you can support the adjustment with appropriate documentation and evidence. In other words, the process has become simpler administratively, but the expectation around the documentation has become even more important. Next slide, please. Okay. This next update is relevant mainly for large multinational groups. So if your group is within the scope of Pillar 2, the transfer pricing is no longer just a corporate tax issue. It also affects your group's minimum tax calculation. So under Cabinet Decision number 142 of 2024, which is effective for financial year beginning on or after 1st January 2025, the UAE introduced 15% domestic minimum top-up tax, which is often referred to as TMTT. This applies to multinational groups of with global consolidated revenue of at least €750 million in at least 2 of the previous 4 financial years. The objective is to ensure that the large multinational groups pay an effective tax rate of at least 15% on their UAE profits. Now, where does the transfer pricing come into this? So before calculating the income that goes into Pillar 2 or globe competition, the UAE requires that the related party transactions must be reflected at arm's length. In simple terms, if a related party transaction is underpriced or overpriced, it must first be corrected to arm's length amount before you calculate your Pillar 2 income. So the transfer pricing directly affects the income that is used to calculate the group's effective tax rate. To further align the UAE's rules with OECD Globe framework, the ministerial decision also introduced additional guidance on operation of the DMTT. So let's explain this with a simple example. Suppose a UAE company sells goods to its related party at a price that is below the arm's length value. As a result, the UAE company reports lower profits than it should. If those low profits are directly used for Pillar 2 calculation, the group's effective tax rate could also be incorrect. Therefore, before performing the Pillar 2 calculation, the transaction must first be adjusted to correct arm's length price. Only then the income can be used for calculating 15% minimum tax. So transfer pricing now has an impact beyond the normal corporate tax computation. It also feeds into Pillar 2 calculation. So in the end, we can say for businesses within the scope of Pillar 2, the transfer pricing and the Pillar 2 teams should work together rather than independently. Okay, next slide. So far, we have looked at the changes in the law. The next question is, how is FTA likely to enforce these rules in practice? Since introduction of UAE corporate tax, most businesses have focused on understanding and implementing the new transfer pricing rules. However, as we move through 2026, the focus is shifting gradually from implementation to enforcement. FTA has made it clear that the transfer pricing is an area of increased attention and businesses should expect greater scrutiny during tax audit. One important point to remember is that under Article 55 of Corporate Tax Law, the FTA can request transfer pricing documentation at any time, and taxpayers generally have 30 days to provide the requested information. That means the documentation should already exist before an audit begins, and it should not be prepared only after receiving an FTA request. So, based on the guidance issued so far and the nature of the UAE transfer pricing rules, there are certain areas that are likely to receive greater attention during an audit. These include, first, businesses with significant related party service fees, royalties, or financing transactions. Second, businesses operating through free zones, particularly where the allocation between qualifying and non-qualifying income needs to be supported by commercial substance, and the groups with complex related party arrangements or significant cross-border transaction. The common theme is simple. The FTA is likely to focus on transactions that have the greatest potential impact on the tax base. For example, if the UAE company pays substantial management fees to a related party but cannot demonstrate the benefit received, or if free zone entity claims qualifying income without sufficient commercial substance, those are exactly the kinds of arrangements that are likely to attract closer review. So the best time to prepare the transfer pricing documentation is before the FTA asks for it. Next slide. Okay. Our final regulatory update is on penalties. There has been quite a bit discussion around UAE's penalty reforms, but it's important to understand what has actually changed and, equally important, what has not. In April 2026, the UAE introduced changes to its tax penalty framework through Cabinet Decision 129 of 2025. The objective was mainly to simplify and harmonize penalties across tax regimes, particularly VAT and excise tax. For example, some administrative penalties have been reduced, and the rules now distinguish between first time and repeat non-compliance. However, from, from a corporate tax and transfer pricing perspective, there is one important point to remember. Penalties reforms do not change the existing corporate tax penalty regime. The transfer pricing adjustment continue to be governed by the corporate tax framework, including its existing provisions relating to late payments, voluntary disclosure, and record keeping requirements. So businesses should not assume that the recent penalty reforms mean transfer pricing has become less risky. In reality, the biggest financial exposure is usually not the penalty itself. It is the additional corporate tax arising from the transfer pricing adjustments. So once the FTA increases your taxable income, you may also face interest and penalties, but those are consequences of the adjustments. The best way to avoid all of them is to ensure that your transfer pricing is correct from the outset and that your documentation is prepared contemporaneously. Just take an example. Imagine the FTA concludes that a management fee paid to a related party was not supported by sufficient evidence and therefore disallows the deduction. The immediate impact is that the company's taxable income increases, resulting in additional corporate tax. Only after that do the interest and the penalties come into picture. So the real financial impact comes from the tax adjustment itself, while the penalties are an additional consequence. So the key takeaway is that do not focus only on penalty percentages. The most effective way to reduce the transfer pricing risk is to ensure related party transactions are at arm's length, maintain appropriate supporting documentation, and be prepared to substantiate your position if the FTA reviews it. Okay. Next slide. Okay. Before we wrap up, we would like to leave you with few key takeaways. If you remember nothing else from today's session, these are the points we would encourage you to take back to your businesses or your clients. First, remember that the transfer pricing is no longer relevant only for the large multinational groups. The arm's length principle applies to most related party transactions, whether they are domestic or cross-border. The documentation requirements may differ depending on the threshold, but the pricing itself must be at arm's length. Second, do not wait for the FTA to ask for your documentation. Whether you are required to maintain a local file or not, you should have appropriate supporting documentation and benchmarking in place before filing your tax return. It's much easier to defend a position that was documented contemporaneously than one prepared after an audit notice is received. Third, keep an eye on new developments. If you have significant domestic related party transactions, consider whether a unilateral APA could provide certainty. If you're planning a downward TP adjustment, make sure you satisfy the disclosure and documentation requirements before filing. And if your groups fall within Pillar 2, ensure that your transfer pricing and Pillar 2 teams are aligned because two of them are now closely connected. Finally, do not overlook connected persons transaction. This is one of the areas we see business underestimate most often. Payments to owners, directors, or other connected persons should be commercially justifiable and supported by market evidence. So if we have to summarize today's session in one sentence, it will be like this. Good transfer pricing is no longer just about preparing documentation. It's just about ensuring that your pricing, your documentation, and your tax positions are all aligned before you file your corporate tax return. Okay. Now we can see lots of questions in Q&A window. However, due to time constraint, we'll revert to your questions on one-to-one basis. Okay. Thank you.
Thanks, Himanshu. Before we conclude, a brief introduction to HexaTP for you. HexaTP is a specialist transfer pricing firm providing end-to-end support across local file, master file, CBCR, benchmarking studies, advisory, planning, dispute support. Our team brings more than 100 years of combined transfer pricing experience and supports clients across multiple jurisdictions and industries. For any assistance related to transfer pricing, please feel free to reach out to our team with the contact details displayed on the screen. That brings us to the end of today's session. On behalf of HexaTP, I sincerely thank Priyanka and Himanshu for their insightful presentation and all our attendees for joining us today. The webinar recording will be available on our YouTube channel for future reference. Thank you for your time and have a wonderful rest of your day.